And the groups that indexes measure can represent any different area in the market. And the common indexes that we listen to, or what you might have heard, are S&P 500 index, which consists of 500 largest companies across different sectors. And it makes up approximately 70 to 80% of the US stock market capitalization. So when they say market is going up, what they're really referring to is the S&P 500 is going up. Okay. Next, we have the Dow Jones index. Dow Jones index narrows that list of top companies to just the 30 largest companies in the USA. NASDAQ composite index has 3,000 companies and is predominantly focused on technology. And lastly, you have Russell 2000, and Russell 2000 includes 2,000 small to mid-sized companies in the US, where the median is about 1.15 billion, which means more than half of the companies are actually small companies. So let's look at the performance of these companies exactly 1 year till today. So S&P 500 is represented by these candle charts. So S&P 500 up till today has brought in 27.14% in 1 year.
Wow.
Dow Jones Industrial, which is top 30 companies, has brought in 19.32%, while Russell 2000 has brought in 15.78%. These are phenomenal figures. But the NASDAQ, which is represented by NDX, right? These are predominantly technology companies. It has brought in 37.51% in 1 year. Right? These are phenomenal growth.
In 1 year,
In 1 year. And on average, S&P brings in about 10%, NASDAQ about 14%. And these are compounded annual growth rates, not simple interest, but compounded annual growth rates. When people say that I don't invest in the stock market because it doesn't return well, I think those people need to rethink all this. And the figures that I'm bringing up are not figures that I'm just making up. This is like, this chart is from TradingView. And it's freely available tool. Just type www.tradingview.com and you'll get this information. Now, carrying on, I also have a similar chart that I created from TradingView, which shows performance of different asset classes. So first, I have obviously the NASDAQ 37.72% and S&P 500 27.23%, and the decimal points is slightly different because I took the snapshots at different time during the day. So previous one has point something else, but these are essentially 37 and 27% of NASDAQ and the S&P 500 respectively for the past 1 year. Now I'm comparing that with a couple other assets, or a few other assets which are very popular. So Indian people, for example, want to put money in gold. How has gold been doing in 1 year? It's 18.52%. Now that's pretty good, but if you look in the long run, gold is basically flat. Okay. I don't like to invest in gold because gold is a non-performing asset. And what a non-performing asset is, that it's not an asset that makes anything, right? Like I have a gold ring, but it doesn't produce me more rings. It's just one ring, or gold chain. It's just one. Whereas Apple products, for example, they'll produce more iPhones, right? Microsoft is going to produce more software. So gold is a non-performing asset. Its up and down goes basically on supply and demand and people's interest in it. Then you have energy. XLE. This is represented by an ETF. Energy over the last year has given 15%, obviously less than the S&P 500. Then you have utilities, XLU, which has given 8.229%. And then you have real estate, which is also represented by an ETF, and that has returned 5.19%. And that has nothing to do with the kind of work Vinney ji does.
Let's qualify that.
Important to note that.
I know, very important.
Should I put
my jaws just dropped. I didn't know that it's 5.19 in 1 year.